Hey everybody, it's me, Mickie Giacomini with Great Talks, and today we have mortgage news for you. All kinds of great news about the California Dream program for this year. So I have Melanie Overmoe here with us, and I'm going to bring her on, and she's going to share all the great details about this program. Hey Mel, how are you?
I'm good, thank you. Good morning, everyone. I just wanted to come on and help Mickie today and talk about this year's version of the California Dream program. That was the program that was extremely hyped last year. Mickie and I actually had somebody that was getting into contract. We were signing on the dotted line when the program ran out of funds.
It
They
sure
lasted
did. That
9
was a
days.
nightmare.
It was a nightmare. The funds lasted 9 days. There were a lot of loan officers and buyers that did things to take advantage of the money that didn't need the money and really should have been left for more deserving people. So this year they went back and really revamped the program and changed it. So it's the buzz around town because
Oh,
it
yeah.
is coming back out. Everybody's talking about it. It is for first-time buyers, but there's a couple of really big caveats this year that are really important for everybody to understand. And again, because mortgage business has been really low in the last 18 months, our volume has been low. A lot of loan officers are out there doing things that are just not ethical and promising things that are not true. So it's really
Right?
important that we talk about the realities of the program and the truth around the program.
I'm so grateful for you to be on today and to help dispel some of this stuff that's going on. I've been hearing some flitterings. Gotta say, I'm learning more from you today as well about the program. I have not even had an opportunity to get well versed with this year's changes to the program because I have been in meeting after meeting after meeting right now because of the NAR court rulings. And
Mhm.
that has to do with buyers and potentially buyers having to pay buyer agent fees, which typically the sellers do at this time. So I've been in meetings for that. Stay tuned. That's a whole other episode. We are waiting for things to finalize on that and see what happens in the next few months. So let's dive in to the California Dream program for this year. Oh my gosh. Please, Mel, tell me it's not going to be a nightmare like last year.
Well, let's certainly hope not. And I do want to say, with the NAR rulings and the lawsuits and everything, there's one thing about real estate and mortgage: it never stays the same. And we always learn to adjust. So, back in 2010, 2011, 2012, the mortgage industry went through some very substantial changes, law changes, rule changes, and we came out of it just fine.
Yep,
And that will happen in this case as well. We just need time for the dust to settle, the
exactly.
rulings to come out, and for everybody to figure out how it's going to work. But it will be fine.
Absolutely.
It's not the sky is falling. So moving
Exactly.
on
The sky is not falling. We
we
just
will
need
be
to see
okay.
what we're dealing with. We just don't
We
know.
just
We
don't
don't
know.
know.
Yeah.
All I can say as a side note is if you are thinking about buying, let's do it now while we know what we're dealing with.
Right,
Call
exactly.
me
Get in
today. Call Mel today. So,
where
let's
you know what's going to happen, and you know who's paying those fees.
exactly,
Exactly.
That's
um
right.
so So, California Dream Program. First of all, the program does not technically roll out until April 3rd. So, anything you're hearing about rates or, pre-approving yourself for the program, you can get pre-approved, but rates are speculative right now. We do not know until April 3rd. As far as qualifying, you do have to be a first-time home buyer, and this is really important. One person on the loan has to be a first generation homeowner. What does that mean, right? Like, I even, as an expert, I even was like, what does that mean? So what that means is you have a parent that has not owned a home or been on title to a home in the past 7 years. And by definition, a first time home buyer is somebody who has not purchased or owned a home in the past 7 years. If you have a rental that you inherited, or you've had it for years and years and years, and it's always been a rental, you could potentially still qualify as a first time buyer. and there's some rules around that, so I don't want to get into that. But in general, if you've not owned a home in the last 3 years or purchased a home in the last 3 years, you are considered a first-time buyer.
Okay.
Okay. This is a conventional loan only. So if there is no FHA with this, it's conventional only, better credit scores since it is 100% financing. You're probably going to have to be a pretty clean borrower where FHA will
Okay.
allow collections and things like that. And I'm not saying we can't do that. I'm just saying it just is conventional. So it's a little tighter restrictions. Back to the parent thing, they will be checking. Now, how are they going to be checking? I'm not even 100% sure. I did a webinar last week. They said they're going to run a third-party verification. Once I do the pre-approval, I enter your loan into the system and I give you a pre-approval letter, and I give that to Cal HFA, and they then put the buyer's name in for a lottery. So all lottery vouchers will be put into their system between April 3rd and April 29th. Okay. It does not matter whether you put it in on April 3rd at 12:01 or April 29th at 11:59. Everybody has an equal opportunity. They will be choosing and do a drawing for those vouchers. It is a true lottery system where they'll pick and choose. Once you have your voucher and you've been chosen by the lottery, you then have 90 days to find and close on a home.
90 days?
90 days. So that 90 days is going to be fast and furious because we only have so many houses in our area in that first time home buyer price range, right? Like that 400,000 to 450 is going to be a really hot commodity. It's going to make some interesting negotiations in 90 days to find that. It could be possible, and this is really important for everybody to know, for you to have a voucher and the funds run out.
Oh, yeah, absolutely, right?
Money. And they're not necessarily going to for lack of a better term, over voucher. They're not going to over commit, but they know there will be some fallout. So they will over commit slightly. So once they get to a certain percentage and they're looking at their locks, they're looking at the number of vouchers, it could be possible that we run out of funds before the vouchers are all fulfilled. So
interesting.
And it could also be possible that there's enough fallout and enough people that don't qualify for the program that we do a second round of lottery. That's possible as well.
That makes more sense, right? Like, if we ran the world, right? Of course. Like, do enough for the funds that would be there if nobody fell out. Just don't crush somebody's dreams. Because that was a dream crusher last year. It really was. It was it was devastating. And
like unfortunately, our client opted not to even buy. He opted that the market was not something that he desired to participate in general at that point. So it was the difference between owning a home and not owning a home. And
it squelched that family's dreams. It really did. And they ended up renting and continue to rent now because they're just like, there is no hope. They felt so hopeless at that point. So I like that they're trying to get ahead of it, but there's still like some of those nuances that it's like toward the end, it's going to bump some people and be a nightmare for some, but hopefully it's a vast majority of dreams for most this time. Because last year that was a crap show. So,
and the other thing that they changed is you cannot be in contract at the time that you are chosen for the lottery. Like you can't. So that's what they did last year is they had people that were already in contract, and then the program came out and they're like, hey, there's 20% down of quote unquote free money. Let's go get that for you and bring your payment lower. And so a lot of people that didn't need it and were already in contract got funds. The other thing that's really important to understand about this program is it is a shared appreciation program. The amount of appreciation that you share is dependent on several different factors and is a calculation that I will do with each individual person because it depends on your
Yeah.
income level and stuff like that. But
Okay.
let's say after 10 years, you have $100,000 in equity and you want to sell the home, you're going to be paying back a portion of that equity to Cal HFA for lending you the money. It is
Mhm.
not free money. It's cheap money, yes, but it is not free money. And it's
Right.
really important that people understand that.
It's
Um,
kind of like well, I guess you always do, but it's kind of like they are a shared ownership, if you
mhm.
will. Like
Yeah,
you own a mortgage, and there's another mortgage
right.
holder, right? And it's like you both are the owners, so that when you sell, the equity is split to a certain extent. I don't know. I shouldn't even
Yeah.
try to explain it because you
No,
did
that is
such an
that
eloquent
is
job.
correct. If you are doing one of their regular programs that exists right now, the My Home program,
Mhm.
let's just say let's do conventional for ease of numbers. You have a 97% conventional first loan, so you get 97% of the purchase price lent to you by the regular first mortgage lender. The 3% is given to you by the My Home program with 1% interest. That is a silent second that sits there silently for 30 years and or until you sell the house. You are allowed a one-time refinance if rates drop. Same with the new program. So you're paying 1% interest. If I order a payoff, I do a rough calculation to see how much I think your interest, your interest accumulation is, and that gets
Mhm.
added into your payoff. A shared appreciation isn't much different than that. This program, the California Dream Program, does not have interest accumulating. So, in lieu of paying interest, you're giving a percentage of your appreciation. It's just a trade off for them giving you the money. It's just not free money. I mean,
Right.
there's other programs out there. I have multiple first time home buyer programs, or even just down payment assistance programs, even if you're not a first time buyer. But a lot of those, the program is funded into the interest rate. You want the
Yeah.
3%, okay, great, but your rate's going to be significantly higher than if you weren't using the program. So it's the whole old saying that there's no such thing as free money.
So true. So true, so true. But at least now we know the scoop for this year. Yay.
Yeah.
And at least there is a program for this year. So there's that too.
And there's millions and millions of people whose parents have never owned a home. And they are a first generation homeowner, and that is the person that they have decided to target. And only one person on the application needs to fit that requirement. So if you are boyfriend, girlfriend, husband, and wife, and you have a parent that never owned a home, then you will qualify for this program in that capacity.
I have some wonderings, but they're percolating. So, okay. So first, okay, got it. All right. Yeah. I'm thinking about clients. I'm already thinking about, oh, I know this person and this person, this person. I'm
Mhm,
wondering. So,
mhm.
okay. And I guess one of my questions is you mentioned like 7 years too, right? For first time home buyers. What
3
if,
years for
um,
first time home buyers, 7 years for the first generation. So there's two different numbers.
and that's anywhere, real estate or
Mhm.
home? It could be land. They could have owned land, but not a home? Or am I getting too technical?
Uh, I would have to check on that. I'm
Okay,
not
yeah,
positive.
I'm just wondering out loud. And and it's anywhere in the world.
Oh,
Yeah.
yeah.
Okay.
They
Not
don't look
just
it
California.
they don't look it out of the country.
Okay.
They won't look
So,
past out of the country holdings.
all right. But if
Um,
they owned a home in Ohio, for example, then they owned a home. So they don't qualify. So,
correct.
okay. Gotcha. Okay. Just wanted to
Um,
clarify that.
if you owned a mobile home in a park not attached to foundation, that is
Okay.
not considered real property. It is not considered real estate, so that is excluded from this as well. So
Oh,
if somebody owned a mobile home, you could still purchase and be considered a first time buyer.
huh. That's an interesting one. Okay. That helps a lot of people.
Yeah,
A
and
whole lot.
that's not just for this program, that's in general. That's an in general rule.
Oh, that's amazing. Well, Mel, I want to thank you for sharing about all of that, and really, if you don't mind, before I let you go today, would you mind giving us a quick update on interest rates and mortgage, how it's affecting mortgages and so forth?
Sure. The biggest news out of yesterday was that the Fed has remained, has left rates unchanged, I should say. They came out at the beginning of the year and said they anticipate cutting rates 6 or 7 times over the next year and a half, depending on how the economy was going to react. What they're saying right now is, we're kind of just still waiting on things, so we're going to leave things unchanged for now. In general, what the Fed does, those Fed rates does not affect mortgage rates. Those rates are for cars, for credit cards, for short-term lending. However, what does affect mortgage rates is the economy overall, the strength of the economy, and what the Fed is seen as they are going to do or not going to do. So interest rates build in these Fed cuts as I don't even know how, like a crystal ball to say, okay, we think we have a 60% chance of cutting rates in July. So based on that, we're lowering mortgage rates. And then that 60% goes down to 30% and then rates jump up. So it's all of this speculation in the market based on way
Yeah.
things in the future. So earlier this year, they thought that the Fed was going to cut rates in March. As that became clear that that was not going to happen, rates started to tick up. And we did get back to levels closer to November, not our highs of last year, but they did jump up quite a bit.
Yeah.
We are kind of seeing them float back down slightly, but we're running, I'm going to say in general, depending on a lot of factors, we're running mid sixes to low sevens on most of the conventional loans, and definitely lower than that on the government products. So definitely not in the eights where we were at the highs of last year, not quite back at the lows that we were, but right in the middle. And a lot of people are finding that, they're adjusting to the rates now. It's not quite as shock as what it was. And they're really looking to purchase now before the craziness starts. If you think it's competitive now to get a house at 450, wait until these vouchers come out and people only have 90 days to find a house. You cannot compete during that time.
Yep,
So
it's going to be insane.
Yeah,
Yes,
for sure.
absolutely. And quite frankly, I mean, that again, it's a good time if you're a buyer to hurry up, get moving, get moving, get moving, get moving. One, because of where the interest rates are. Two, before the prices start jacking up. And three, like Mel just said, before those vouchers start coming out, because, oh my goodness, the next few months, like I always say, the roller coaster ride of real estate.
That
It's gonna get crazy.
If you think it's boring, blink, it'll change.
I know, right? So true. Okay, well, thank you so much for the updates. We appreciate it, and we will see you next time. Thanks, everybody.
Thank you.